Here we are. It's September. Market update. We've had a really busy and eventful week this week with the passing of Ruth Bader Ginsburg last night. I think it's important to, just simply state that no matter what side of the aisle you're on, she really was an example for women and to move women's rights forwards as well as civil rights and equality. I don't think anybody can deny that, and had an amazing life story. That said, we're jumping into the market update. As you can see, the Bureau of Labor Statistics has basically seen falling unemployment rate at about 8.4% now. This is really fantastic. It's not exceptional. I mean, we have 8% unemployment right now, but it's significantly moving in the right direction as we continue to work out of the shutdown that we've been in for a while. For the city of Los Angeles, we are currently slightly higher. Now, this is July's numbers because August's numbers don't come out right away. I suppose we will probably see a drop from the 18.2% that we're showing right now currently for the city of Los Angeles. But I don't know how much. Our economy is driven heavily by the hospitality industry and the entertainment industry. Both have been furloughed and account for a large portion of our economy, which, says quite a lot, which is why we have such a high unemployment rate. That said, I did have somebody who wanted to know a little bit about where migration patterns are happening currently in the United States, especially with California. Unfortunately, we can't get current migration patterns, but what this is this is from one of the moving companies, a map of where they're doing their orders and moving people to and from. California is absolutely an outbound state, has been for several years now. What we are seeing is that people are leaving. My hunch is, and suspicion based on the numbers that I'm looking at, when I look at sales and I will look at rentals and whatnot, is that it's been on a major outflow since COVID started. And I've had multiple conversations with people who have announced that they have left or are leaving. And it's not uncommon right now. So California is on the outflow. That said, jumping into the buyer traffic number, we're actually seeing some positive signs. The home buyer traffic jumped again in July and recording a 60.7 year-over-year increase in nationwide showing activity from showing time. As far as the inventory, though, our inventory is down over 38%. The number of homes that are out in the market available for sale has shrank drastically, and we're seeing that in Los Angeles too, in certain types of inventory. Total inventory was down 38%. Buyers continue to be motivated by low mortgage rates. This is one reason why we're seeing increased showings, and a strong desire for the certainty of ownership in an uncertain world. They are quickly putting offers on homes that come up for sale and driving the overall number of homes for sale lower. And this plays out in the future of home prices. We have been seeing projections being changed. These are the current projections for 12 months from some of the biggest, actors in the mortgage and home sales business. All of them have pretty much revised themselves, and when we look at the major adjustments that each one's made in how much they've adjusted. Fannie Mae adjusted a full 4%, Zillow a full 6%, and CoreLogic has moved a full 6% as well. Why is that again? Well, on an aggregated level, the housing economy still remains pretty rock solid despite the shock and awe of the pandemic. And this is from the CEO of CoreLogic. What we're seeing is just low inventory and a lot of buyer demand as buyers transition from urban areas to suburban areas. There has been a preference shift in what buyers want. They don't necessarily want to be in the big city anymore if they don't have to. This was a work requirement, which how we approach our work is also in the process of changing. And probably for the better, I think. I think it'll give a lot more of people's time back to them, and at the same time, take it away as well, because employers are going to expect a hell of a lot more from you. So moving on to the updates. One of the conversations that we are continually having with my clients as I'm out there and we're looking for property, and the expectations that they have with what's coming down the pipeline, is that there's going to be this massive wave of foreclosures. And guys, there's not going to be a massive wave of foreclosures. And there is a specific reason why. But first, let's look at the forbearance numbers, and we'll work our way into the reasons why we're not going to see massive amounts of foreclosures. First off, the number of active forbearance mortgages across the country has gone down, and these are numbers are in the millions. So what we're seeing is that, when everything was shut down from May through June, the forbearance numbers were higher. Well, then it dropped in July. Well, why? Well, because a large portion of the real estate homeowners out there have a huge majority of equity in their property. So if someone is going to get into trouble, they're not going to send it to foreclosure. They're going to sale. And forbearance basically means we're not making our payments, we're in trouble. So what did they do? Well, as soon as things started opening up right around July 4th, they sold. So we had a lot of properties go off the market and sell instead of going to foreclosure. Now we're sitting in August at about 3.93 million properties that are still in forbearance. That is a trickle compared to what happened during the Great Recession. An absolute small number, an extremely small number. In fact, so much so, the COVID-19 pandemic will lead to a rise in mortgage defaults and foreclosures. But as the housing market muscles through this economic downturn, it's as if foreclosures will form a trickle rather than a flood, housing experts say. And that's a reporter from Bankrate. I'm going to show you why. When we look at the percentage of distressed properties that are out there in the market, compared from January 2012 to today, January 2012 was at 35%. And I'm going to keep beating this home in people's heads so they can get the idea that this is not going to be the recession. Now it's less than 1%. Less than 1% of all sales are distressed sales. So if you only have 3.93 million properties in forbearance across the entire country, that doesn't equate a 35% foreclosure distressed sale rate at all by any means or measure. So those shopping for a home can actually afford 10% more of a home than they could have 1 year ago while keeping their monthly payment unchanged. This translates into nearly $32,000 more in buying power. Now, remember, this is across the United States. It's not just, per se, Los Angeles. But I think that the next slide here, the Housing Affordability Index from 1990 till now, speaks volumes. And the reason why it speaks volumes is when you look at this, you're seeing that 164 number. That's kind of like an index. It's an indexed ability of people to afford a home. We're not at extremes on either side. We're not at extreme low. We're not at extreme high. We're pretty much where we probably should be right now, at least for the next couple of years. And I'm not really expecting any kind of a spike out of this. I'm expecting this to continue. In fact, the problems that we're going to have is probably going to be shortages of availability of properties on the market. That's probably going to be our challenge for the next couple of years as demand stays at these highs. We believe the housing sector will continue to be a relative strength amid the larger downturn. The recently observed increase in purchase demand is largely due to pent-up demand as buyers are acting now after delaying purchases in the spring. We are, however, seeing some early signs of shifting buyer preference to locate to lower density areas, potentially driving some additional purchase activity. This is exactly what we're seeing playing out. especially in Los Angeles. We're seeing more and more people opt for single-family houses over condos. We're seeing people move to farther out of the city. We're seeing people move to other states where they can be in suburbs and have a yard and a dog and all those great things that everybody wants for themselves, and not be on top of each other. We are seeing it. That said, our 30-year fixed mortgage is still at lows. It is anticipated that it's going to stay around this area for at least 2 more years. I was on a Zoom call with Barry Sternlicht, who is the CEO and officer of Starwood Capital. And now they're a major real estate firm for hotels and retail and malls and all the other things out there. And in his own words, it's really, really hard to raise bond rates when Europe is running negative. Can't do it. It's not going to change anything. That said, let's jump into the sales. All right, single-family active listings right now. We are at 10,180 listings. That is a 23% decrease year over year from this time last year. That says volumes. So I want you to pay attention to this number because the low amount of listings available is driving what we're going to see. Pending sales have also fallen slightly. We saw a huge spike in June, July. Since the pandemic began, and it's playing out right now. That's kind of the spring pent-up demand. It's kind of come out. People have bought, and we will see where we go from here. I don't expect us to fall to the depths at all, but I would anticipate that it will probably stay somewhere in this range for the remainder of the year, with little peaks and valleys along the way. As far as closed sales, we are only 5% below last year's closed sales, which means that we're still within the range of normal sales activity. So what happens when you have active listings and closed sales? Well, you can see that the number of listings available has kind of dwindled while the sales have remained relatively constant, which is a good sign. That's a healthy sign for a healthy market in which people are actually buying and selling and able to trade somewhat. As far as home prices are concerned, the median sales price right now has risen a lot. And this is due to the low inventory. When we see inventory this low, it's only natural that bidding wars begin and prices rise. In LA County, which is what we've seen, the median price has risen to $780,000. That is a 14% increase year over year. It's a pretty big jump. Remember, though, at the same time, affordability has increased as well due to the lower mortgage rates. Something to keep in mind. The average price per square foot has also risen drastically. I will comment that when we look at average price per square foot, most people tend to think that that involves luxury listings, and that's just not the case. The sales that are generating the most heat right now are the first-time buyer and second-time buyer homes. So that's everything from $500,000 up to $1 million. That is really where the sweet spot of all the activity is happening right now. The higher end listings are moving at a trickle comparatively. So if more and more people are buying those first time buyer homes and they're causing those prices to rise, if that is the median of the market, it's going to move this number much, much farther. So I wouldn't read too much in it. It's just a gauge to tell you, okay, here's how much things are in general moving in this direction. The month supply. The month supply has dipped really, really low. As I mentioned before, we're at 2.9 months. That's 20% below last year's month supply. When we look at the shadow inventory, this is the inventory of people who are pulling their homes off the market, and sometimes they'll put them on, take them off, put them on, take them off. It's like a really bad, really terrible listing agent who just has no idea how to market a property. That's basically what it is. Sorry, it's true. That said, there's probably about 1,000 listings out there in LA County right now that are sitting that probably could and should sell if they had the opportunity and the right buyer to come along and the right agent to market their property appropriately. When we looked at all of these numbers together, here's, again, I started putting this chart together to kind of demonstrate the overall concept of prices rising versus low inventory. So our active sales are there. Our closed sales are also there. And we can see that the listings are really low. The sales are pretty normal. And the average price per square foot is rising. Again, so steady demand, low supply, rising price in per square foot and median. It's economics, people. If you haven't taken a class, take one. Condos, moving right into it. Condos are in a different situation altogether. The preference has shifted to single family. We have seen that pretty drastically. It's a push. Condos, the number of active listings has increased it to 3,379. That's a 10% increase year over year. The pending sales has decreased by 20%. We are at 764 pending sales currently. Don't fret, if you're paying attention to the chart, you will see that there was a spike in sales, meaning that many people came in and bought, and that was the spring rush, and now we're kind of seeing where things fall. But as far as closed sales, see, the closed sales are still fairly strong. So we're within the range on the closed sales of demand, not that far off, pretty much flat from last year at this time. The median sales price has risen back to what it was, again, close to what last year, a little bit above last year. That's a 10% increase. That is $529,450. That is for the entire county. So if you own your super duper special, I had it super designed by blah, blah, blah interior designer in West Hollywood, well, good for you. This doesn't apply to you. The average price per square foot, though, is sitting right around $532 as well, and that is a 5% increase year over year. Here is the kicker. The condos month supply is starting to build up. It is at a 20% increase year over year. That is 4.2 months. Now, I believe that there are two reasons why this is happening. One, there were a lot of investors who owned condos who had them as rentals. And as the rental market has started to expand and there's massive rentals available right now, this is causing them to put their condos on the market and sell them. In fact, I know of clients who are dealing with this and doing this right now currently. That said, let's take a look at the lease numbers. So for lease for rent, we're using apartments.com as our metric right now. It's the best resource out there, unfortunately. The realtors have a lot of data in the MLS for the leases that they do. In fact, over the past 3 or 4 months, they've done thousands and thousands and thousands and thousands of leases. So it's not like we're not involved with this business. But we use this. I'm using this as a metric because it covers more of a broad swath of the rental market. Now, you can see that it is currently sitting at 35,000 available properties, and just a month ago it was at 33.5. So the month before that was about 35,000 as well. It means that there's been a little bit of shuffling, but ultimately there's a lot of listings a lot of inventory on the market. I am expecting some kind of a correction in the rental rates in the market. It is subjective and it depends on how long this goes on, and especially how long that moratorium goes on. Once the moratorium ends, it's going to be a lot of shuffling going on. A lot. So this is one area of the market where I do express concern, and I do think that there's going to be some falling out. As renters who have built up $10,000, $15,000, $20,000 in mortgage in rental payments that they cannot afford to pay back within a certain amount of time, they'll walk away, and they'll probably do their best to go BK. So this is an area of the market that is concerned. So I'm watching it. Listen, if you have any questions about your own circumstances or your own situation, you want to talk about maybe buying or maybe selling, I'm happy to go into what we do differently and how we help people. I look forward and I hope that you'll reach out just as soon as you can. I'm Dennis Maynard, and have a wonderful weekend.